fascinating study you did, but take us through it a bit. You went back over 100 years, the 10 biggest bubbles. What were the things that you found in common about these bubbles?
So what I did was to look at the 10 biggest bubbles of the past century and see what were the common features here. And some objective characteristics were present in all the bubbles, and some of it was obviously subjective. But the one common factor was this, that typically a bubble is a trend that has been going on for a while, and in the final year, the final 12 months, you see a massive acceleration in that trend with prices increasing by typically 100% over a 12-month period, and a lot of the gains packed into the last few months of that 12-month period. So that is the most objective criteria of looking at any bubble. The more subjective one is that it's also accompanied by a lot of speculative activity, frenzied trading, mass retail participation. Those are some of the other subjective criteria that go hand in hand.
I think it's fair to say just about every week we're seeing some frenzied speculation someplace or the other, but applying your objective criteria, that 100% run up to the peak, what do you see right now in the marketplace? Where do you see things that fit those criteria?
So I think if you look at both the objective and the subjective criteria, and remember, about a bubble is not just something about one stock rising. It's a concept. It's about the fact that everyone believes in some new thing, that this concept is here to stay and about to change the world. So it is, as I say, a good idea gone too far. So what is it in the marketplace today that we see which looks like a bubble? So I think that you see this in obviously some of the cryptocurrency space. We see this in some of the clean energy stocks. We see this in some of the SPACs. We see this in some of those pandemic stocks, the small cap stocks, which have benefited a lot because of the pandemic. And we also see this in some of these tech companies that really have no earnings. So there are various indices on Wall Street that define these trends. And these are what I call bubblets. I think that this is a slightly new concept. Bubbles are the entire market wide, right? That you had the big bubble of 1929, you had the Chinese A-share bubble of 2015, you had the gold bubble of the 1970s, oil. Those are the really big market bubbles. But I think that one step below that is what I call bubblets. These are not market-wide bubbles, but sector-specific bubbles.
Ruchir, as you look at past bubbles or bubblets, do you see situations where there's a correction and it resumes its rise up, or is there a correction and it resumes its fall down?
That's a great point, David, and we looked at that specifically. And here's what I came up with, which is that if you look at most trends, nothing goes up in a straight line. It only seems so in retrospect. But typically what we found was that you have drawdowns of around 20-25%. Those do not classify as a break in trend. But once any of these trends decline by more than 35%, that usually marks the end of the bubble. That means the trend is broken. And they often go on to decline as much as 70% from the peak over a 2-year time horizon. So that is the broad template. And what we see in the bubblets today is that most of them have declined by more than 35%. So that's what makes me feel that the trend is broken in many of these bubblets, and we may have further downside in the months, if not quarters ahead.
One of the big debates going on in all sorts of ways, including with inflation and other things right now, is it different this time? And certainly it is different, at least in the fact of a very rapid fall in the economy as we shut it down, and then a very rapid rise. But it's also different in the degree of monetary and fiscal support for the economy. Could that make us have a different result when it comes to your bubblets?
Yeah, it's entirely possible. We have never had such an extraordinary accommodation in monetary policy and fiscal policy to go with it. There's one statistic I keep repeating, which is that 20% of all the dollars in circulation in the world were printed just last year. So that's an extraordinary amount of monetary accommodation. And even if you end up getting some hawkish noises from the Fed and other central banks, to reverse that accommodation will mean a lot.
Ruchir, Jay Powell, the chairman of the Fed, hardly has an appearance that he isn't asked about bubbles, whether we're creating a bubble because of monetary policy. Thus far, he says that there is some froth, but he doesn't really see it. But let me ask a different question, which is there anything the Fed can do about it? We saw this week in the FOMC decision and then Jay Powell's remarks, and of course that dot plot, some indication that at least the Fed is going to come off of the rampant acceleration in the monetary stimulation and go toward a world where they start to pull it back. Could that help relieve some of the bubblets?
Well, I think so. I think that the real issue I've had with the Fed's monetary policy framework for a while now is that it focuses too much on just consumer price inflation. And there is not enough attention paid to asset price inflation. And I think that this is an outdated framework, because if you look at the past few recessions in both the United States and in other parts of the world, what you see is that most recessions now are caused by financial instability. And how do you get financial instability? You get financial instability when an asset bubble typically goes bust.
And finally, Ruchir, even if there is a bubble or a bubblet that goes bust, the air really comes out of it, could there be some good that comes out of it? I mean, you talk in your piece in the Financial Times, actually, about what happened with the tech bubble, if I can call it that, in the late 1990s into the 2000s.
Yeah, I distinguish here between good and bad bubbles. There is something like this. All bubbles have negative consequences once they burst, but something comes out of a good bubble compared to a bad bubble. What do I mean by that? A good bubble, I mean, if it's happening in industries such as technology. We saw that in 2000, that a lot of the ideas in 2000 were premature. A lot of the digital infrastructure that was set up there lay waste for a while, but it did set the scene for the tech revolution to take place a few years later. So generally, tech-oriented bubbles tend to be good. Something good comes out of it. And I think that's true because it attracts a lot of capital. So whether it's got to do with some of the clean energy concepts just now, it's got to do with concepts like teleconferencing, and those stocks may not have earnings today, but something good comes out of it.